Good morning. Today is Monday, July 18th. Hope you had a good weekend. The markets are up to start the week, so following on from the nice rally on Friday. We're going to start off by talking a little bit about some companies and then go to some jobs numbers as well and reassess that. So first of all, talking about Goldman Sachs, we talked about Citigroup last week, how they performed well on the trading, and Goldman Sachs actually performed extremely well on the fixed income currencies and commodities trading at FIC trading. As they say, it was up 55% on a year-over-year basis due to the heightened volatility in fixed income markets. This was a thing that really dragged on Goldman in about 2017 to 2019 under the initial leadership of David Solomon. However, that's improved now, and they are proving to be very good at collecting spreads. And basically, their client's loss is Goldman's gain. So that's the game they played. Also, I did think that M&A advisory revenue was only down about 3 to 5% on a year-over-year basis. And that was a lot better than I had expected, given the number of mergers and acquisitions we've seen. So they're holding up a little bit better on the investment banking side than some of the other businesses. Tom, what are your thoughts?
I mean, I think that Citi was a good read through on this. Citi and Goldman are probably the two best in class when it comes to trading revenue. Goldman Sachs had a tough time when volatility was very low, particularly in fixed income for 3-4 years there between kind of 2016 and 2020. And so they attempted to pivot and kind of go into more advisory assets. They launched that whole arm of Marcus, which we used to get a lot of commercials during golf for Marcus. And that seems to have fallen off because at the end of the day, volatility came back in the market. They were able to capitalize on that the way they always have. And it turns out that's still their bread and butter. And so, I think going forward, Citigroup, Goldman Sachs probably in a better position than something like Wells Fargo, which has a pretty terrible investment arm. So I think this is good news. I think this is something that they can make money on. A lot of people are worried about the banks, the inverted yield curve. How are they going to make money on loans? Well, that's not really Goldman Sachs' game. They make money on volatility. They make money on recommending securities. And I think they're going to be in the driver's seat going forward.
And this is one of the reasons we do own Goldman Sachs in client portfolios. We think that they are a little less cyclical. Arguably, they're a bit counter-cyclical in terms of their earnings stream. Obviously, their stock is not going to be counter-cyclical, but at least their earnings stream can hold up better in negative markets because they actually make more money when markets become more volatile, and not just equity markets, but fixed income markets also.
And to the point on the mergers and acquisitions, if I'm not incorrect here, they were the ones advising Twitter. So they probably made quite a bit of money on that. They're probably going to continue to make money advising them through the potential lawsuit. They've got their claws in everything. And I think that's one thing that, other banks aren't involved. Goldman Sachs is the king. That's going to continue to make them a little more hardy.
Yeah, whether or not anyone makes money, Goldman will make money.
Right, exactly.
Good news for them.
They're like attorneys.
Yeah. Alphabet splits 20-1. That's going to take place today. So the value of your Google stock did not just go down 95%. You actually have 20 times the number of shares. The stock is up a little bit pre-market. It follows a split of Amazon. It follows a split from Shopify. Tesla's done a number of splits, and now we don't have any more of those $1,000 tech stocks because Google's going to be trading at about $110 or so, maybe a little bit above. Tom, do you think that this is good news for Alphabet, deserves to trade at a higher multiple now? And C, do you think either Google or Amazon have any opportunity to get into the Dow? And if so, which one?
Yeah, that's tough. The question is, who would they kick out? Who's the least relevant Dow component at this point? I mean, maybe somebody like 3M. It's kind of hard to say. But I think that they're both gunning for that. I think probably only one of them gets in. I think that Amazon probably is the top choice. Just because they're, maybe they kick out Walmart or somebody and replace it with Amazon because it's a more modern version of that piece of the pie. It's kind of hard to say, but I think they're more well-positioned. They're obviously a bigger company by market cap, probably. I guess we'd have to look. They're probably pretty close at this point, but I think Amazon gets in. I think Google gets in later, but I think it's probably going to take a little bit of time would be kind of my read on it.
And do you think that now the stock is quote unquote cheaper, it deserves to trade more expensively?
Not necessarily. I think it makes it more approachable, though. I think there are a lot of retail traders, with all the AMC and GameStop and all that, they probably don't have $2,000 to play with, so that's why they're going after these tiny stocks. But I think, at a $200 or $100 price, you can get in there and actually own a piece of Google, which was not always the case before. I know it took a long time before I felt comfortable putting that much money into one stock, as I was building out my portfolio over the years, because, if you've only got $10,000, $15,000, I mean, that's more than a 10% position. And now you can be a little more tactical with sizing, and it helps with younger, smaller clients here, even for us, where we can start having those Google and Amazon as key components of those portfolios without having to spend $6,000 just to get both of them in the portfolio.
Yeah, Finance Theory 101 says this should not make any change to Google's valuation. Having said that, I do think that people could accumulate Google shares. It might be included in the Dow Jones Industrial Average. And the final piece is, what does it replace in a client portfolio? And I think that it could replace something like Meta. It could even replace something like Apple if people want to right size their Apple position. So all of a sudden you see a little less imperative to own an online advertising company like Meta when you can buy Alphabet, which has 70% market share in search and has a lot more cash and growth opportunities as well. Jobs numbers. We talked a lot about the jobs numbers last week. We have been talking over the last number of weeks. And one of the surprising things is that the monthly jobs number continues to come in a little bit higher than expectations and higher than what we would anticipate in the economy. The establishment survey. So there are two surveys that are done in the monthly jobs numbers. So the first one is the establishment survey. This is when people go out and survey actual businesses of how many people are on their payrolls. And so this is that plus 375,000 number. They also do another survey, and that's called the household survey. And the household survey generally has a lot of noise because you're calling random people and saying, do you have a job or not? The problem is the household survey is extremely volatile, so it's difficult to draw a trend. But in the last few months, household survey has been coming in significantly weaker than the establishment survey. So when you're actually talking to people, they confess to having a job less frequently than if you're talking to businesses. And there are a couple of reasons for this. Number one is a difference in definition. So the household survey includes workers in private households. So think like nannies, housekeepers. It also includes people who are self-employed or farm workers. So that's a household survey. In addition, someone with two jobs is counted twice in the establishment survey, but only once in the household survey, which makes sense because if someone has a job at Walmart and also has a job at Chick-fil-A, Walmart and Chick-fil-A will count that as two jobs versus you call that guy who's working at those places and he says, yeah, I have a job.
Yeah. Are you unemployed or employed? The
Right.
answer is yes, but he's not employed twice, technically.
So it double counts the people with multiple jobs. Overall, what I would say is you probably want to go with the establishment survey usually, but at those turning points like we may be at right now when jobs market is turning, the household survey may give you a little bit of an earlier indication. The LinkedIn economist, Guy Berger, he sees a lot of this data. He says that hiring on LinkedIn is down 12% on a year-over-year basis. And he says, quote, to my mind, I'm a little bit nervous when people run around saying, look at these really good non-farm payroll numbers. Maybe they overstate the strength a little bit. I think the truth is probably somewhere in the middle. But Tom, I'm wondering if A, you think what is the truth in your opinion? And B, does the Fed care about it? Or do they just look at the establishment survey?
I think that layoffs are accelerating. I think they're accelerating rapidly. And I think that there's plenty of people who don't want that information to be readily available to people. I mean, if you look at that layoffs side, FYI, that we looked at in the macro, we've already surpassed Q1 in terms of layoffs in the startup space in the first 18 days of Q3. So, I mean, that's an obvious acceleration. Q2 was a bloodbath, akin to March of 2020, and Q3 is already the second worst quarter by a mile in the first 18 days. I think that the truth is really more closer to the household number. I think that if you ask real people what's going on, they would tell you. I think if you ask some sort of economist or talking head or person on TV or even government official, they'd want you to think everything is fine. It continues to be the consumer is strong, the economy is strong, the jobs market is strong. And I don't think any of those things are as true as they were 6 months ago. I think it gets bad. I think the job market gets bad. I think that the Fed, whether or not they care about the household survey versus the actual established surveys, I think that their path is laid out for them. I think that they're going to raise rates aggressively, and that's going to cause a lot of unemployment. But the key is to get the inflation down, which eventually will make it so those jobs come back. But I think it's accelerating. I think it's accelerating rapidly and probably a lot faster than people think.
Well, let's camp out on that really quickly, because it seems like the expectation for rate hikes has come down somewhat over the last, I guess, 2 trading days. And the reason seems to be a couple of hawkish members of the Federal Reserve talking a little bit more dovishly, and it seemed like that 75 basis points is more kind of what's going to happen. Question is, and I think it's definitely coincided with a rise in market prices and rise in stock market and kind of a sigh of relief from equity markets. Do you buy into that, or do you think that there's still a chance they go 100?
I think there's a chance. I mean, if you look this morning at futures, we've got about a 25% chance, which is down from almost a certainty as recently as Thursday. But I mean, 9 days is a long time. There's a lot of information that could come out. There's a lot of things that could develop in terms of what the Fed sees that could push it up, it could push it down. Right now, I think the base case is definitely 75 basis points. I think realistically, they probably should do a point just to continue to push on inflation. But the timeline, like we talked about last week, for a hike versus when it actually takes effect is extremely protracted. And we're already starting to see commodities come down. We're starting to see oil come down. We're starting to see auto prices come down. So I think that there's, a little bit of a holdback to say, hey, we're going to do 75. We're going to reassess where we are next month is probably smart. I think that there's some definite cracks in inflation that, even though we posted the highest number since 1981 last week, that may be the high water mark. But, we said that back in March, and then we had the war in Ukraine break out. So, it's very difficult to assess what could happen even in the next 10 days.
Yeah. So on the war in Ukraine, Nord Stream 1, which is the pipeline that goes from Russia to Germany, it seems like there is some optimism on gas supplies to Europe right now. It is scheduled to be restarted on Thursday. There's no indication from the Russians that will actually take place, but the Canadians actually waived a sanction they had in terms of supplying Russia. So the Canadians gave them a turbine to actually propel more gas through the pipe. And so what they're going to do is, so they waived that sanction for that brief period of time. They shipped the turbine over to Germany. Germany is now going to ferry it over to Helsinki in Finland, and then they're going to transport overland to the Russians. Obviously, this is causing a ton of controversy. Canadian members of parliament are not happy. One of them said, I'm very worried about the precedent this sets. We're allowing the Russian Federation to weaponize energy around the world, which is extremely, extremely dangerous. And I would just say they've already weaponized energy. And part of that is our own doing in terms of not allowing imports. But again, this just speaks to the critical nature of natural gas as an input, not just for energy, but also for raw materials, glass, plastics, chemicals, all of the above. But it does seem to appear that this news of more gas supplies to Europe is good for the European economy, and it's good for markets. The euro is now over 101 to the dollar. European stocks are rallying. Bond yields are going up as there's more optimism in the economy. Tom, any thoughts on that?
I mean, it could be a head fake if this doesn't actually pan out. We could see all that reverse very quickly. And it's really dependent on what Russia decides to do with it. They could just take that turbine and just be like, thanks, guys, we'll put it in when we feel like it, and really turn up the heat. And that seems to be sort of the modus operandi that we've had, which is that, Russia will basically do whatever they can to maintain leverage. And even if it goes against the goodwill of whoever's being the good guy, obviously we've seen a lot of pain as a result of being the good guys, and Russia doesn't care about that at all. They'll operate however they want to, sort of regardless of the morality of it.
Yeah, it's interesting. I think the only reason that Russia would actually continue to supply gas is the appearance of trying to portray that they're still above board. But I think that I don't think anyone really believes that they're above board. So from Russia's point of view, I don't know why they would switch gas flow on again.
Yeah. I mean, it's
Other
funny
than
'cause,
for
like,
legitimacy, but I don't why would they lose that bargaining chip?
I mean, it's interesting because, like, theoretically, we're big time capitalist nation. We should be thinking Ayn Rand, self-interest. How do we most benefit ourselves in order to progress? But actually, we're doing the opposite. You were trying to be the good guy, altruistic, and everybody else is doing that. Saudi Arabia, China, India, Russia are all acting in their own self-interest, and they're benefiting from it significantly. And it's an interesting sort of twist of philosophies.
Big earnings week this week. Goldman and Bank of America this morning. We have IBM tonight. Tomorrow we have some pharmaceutical companies. In the morning we have JB Hunt in the evening. The big ones that I am watching, however, come not till Friday. We got American Express, Schlumberger, and HCA. Obviously, a huge financial company, energy service company, and hospital company. So those will report on Friday morning. But on Wednesday and Thursday, we have some big news from the bond market. On Wednesday, we have a 20-year bond auction, and on Thursday, we have both an ECB meeting and a Bank of Japan meeting. At the ECB meeting is going to be incredibly important to watch because they're going to be talking about fragmentation and what's going to go on with the euro. That could have some significant consequences for the euro currency. Tom, talk us through the bond auction that happens on Wednesday, where you think that might go, and then also some of those central bank meetings.
So in terms of the 20-year bond auction, I mean, we've yet to see strong demand for that since they launched it in May of 2020. It's the high point on the yield curve. 30-year was very strong, but at this point, people I think would rather lock in for 30 than 20 years. So we'll see how that goes. I don't anticipate a ton of demand for that piece. We just haven't seen it. So if we do see it, that would be a change in the overall feeling in the bond market. In terms of the ECB meeting, I believe as Morgan Stanley put out some pretty interesting stuff over the weekend about the dangers of upside risk for the ECB on their balance sheet should they have to combat fragmentation, which essentially, the U.S. is tapered. We're now net selling bonds. Interest rates are rising in different parts, and that's just kind of how it's going to be. Whereas in Europe, they've had just rocketing yields in some countries, and some haven't moved that much, and so they've got to turn around and basically do a more targeted nation-specific asset purchase program in order to keep yields down in some places. But what does that cost? I mean, that basically involves printing more money and using that to buy bonds, which is going to stimulate inflation. So they're kind of in a pickle in that regard, that either rates are going to blow out of control in certain areas, or they've got to blow their we got a big A spider on the table scaring Ben here. I'm gonna get it. I'll flick it. Save the day. No fear from this guy. And now it's dead. Pardon my French there. It got a little wild in here for a second. Where was I? Oh yeah. So they're basically, Europe is in a position where they need to be unwinding their balance sheet, but in fact, they're going to have to end up expanding it in the same way that Japan is having problems with rocketing rates there, and they're having to taper. They're having to do asset purchases as well to keep rates down. And so Morgan Stanley put out a couple of charts about who has the most wiggle room in terms of expanding their balance sheet. And the short answer is the U.S. is actually still in a pretty good position in terms of the Fed's balance sheet versus GDP, whereas Japan is in terrible position, and Europe is also in really bad position. And so, they've got a lot of risks there. So high drama here on the call today with the spider. And I think
We'll leave it there.
We'll leave it there. Thanks, everybody.